Good morning, everyone. Import prices just logged the biggest jump in several years, and suddenly the rate cuts are coming story looks like it has been put in a drawer. That is the tension hanging over today's open, and it is exactly what we're going to debate on Capital Sound.
Morning, Mandy. That import price story is like a gust of wind that rustles the whole orchard. It doesn't topple the trees, but you notice it right away.
Victor Stone is here with me, our resident value sage. Today's debate is simple on the surface and messy underneath our markets. Right to shrug off inflation and oil headlines, or are we stepping into a day where risk shows up in the tape? Victor, let's set the stage for the morning.
Sure thing. I start from the balance sheet because that is where the truth is when the headlines get noisy. When you have inflation, anxiety, and oil risk in the air, the market tends to split into two camps. One side says, companies with steady cash flow can handle this. The other says costs squeeze margins, and if oil spikes, that bleeds into everything. Both are plausible, and that is why the market feels divided heading into the open.
Let's anchor the debate. The issue is inflation expectations at the short end and the market cooling on the idea of rate cuts this year. That is one side of the tension. The other is geopolitical risk tied to the Middle East and oil flow. Those are the stakes, rates, and energy. Why do you think the market is so split on this?
Because the data is noisy and the signals are mixed. We've got import prices climbing, which is a real input cost pressure, but we also have businesses that built resilience over the last couple of years. Many kept debt levels reasonable, pushed through price increases, and built in a little buffer. Think of a paid-off farmhouse. It is not fancy, but it keeps the family warm in a storm. That is the kind of balance sheet a lot of quality companies have right now. The question is whether that buffer can handle another wave of cost pressure.
So we're debating whether today is a shrug or a warning. I want to do this cleanly, bull case first, bear case next, then we'll cross-examine you game.
Absolutely.
All right, take the bull case if investors are right to be calm. Why?
The bullish red starts with a cash flow statement. Many large, high-quality firms are still generating steady free cash flow, and they've been conservative with debt. That means they can absorb some input cost pressure. The market might be right to shrug this off because the strongest businesses can pass on some costs or find efficiencies without cratering their margins. In that sense, this inflation uptick is a speed bump, not a sinkhole.
So the bull case is strong balance sheets and pricing power. What else supports it?
Another support is that a lot of this inflation narrative is being priced as a headline risk, not a deep demand shock. Consumers have shown a surprising willingness to keep spending. Even as prices rise, that gives companies a window to maintain revenue also. If you look across sectors, defensive pockets like healthcare and staples tend to hold up when uncertainty rises, which can stabilize the broader market. If I'm wrong here, it would be because costs outrun pricing power faster than expected, and margins get compressed more than the market is ready for.
That is one bullish thesis and one caveat. Give me another bullish angle and make it different.
Fair. Another bullish angle is that markets are already treating the Iran headlines as a known risk. When a story is widely broadcast, the shock value diminishes. The market might be right to keep its footing because companies have been planning around supply chain disruptions for a while now. The one thing that would challenge this is if energy prices jump sharply and suddenly, because that feeds into transportation, manufacturing, and consumer budgets all at once.
You are saying investors are treating the geopolitical story as a known, but it could still surprise. That is the bull case. Now, the bear case, if today turns sour, what does the bearish argument say?
The bear case says inflation is stickier than investors want to admit, and that makes interest rates more restrictive for longer. If short-term inflation expectations rise, the odds of rate cuts fade, and that raises the discount rate on future earnings. Put simply, investors are paying less for future earnings, and that compresses valuations. That kind of shift can hit growth stocks hardest.
And the energy piece?
The bearish view takes energy seriously. If oil tightens, it is like a higher tax on the economy. It raises costs across the board and can cool demand. That doesn't have to be catastrophic, but it can be enough to wobble sentiment for a day or two. The market might be underestimating second-order effects, like rising transportation costs and tighter credit conditions for smaller businesses.
You also mentioned private credit stories in the headlines. How does that fit the bear case?
That is a quieter warning light. If private credit is under strain, It can tighten financial conditions without showing up in public markets right away. Think of it as the root cellar stays steady until you open the door and realize the temperature is changing. It doesn't mean crisis, but it can slow growth if lending gets stingy.
Let me push back a bit. We talk about inflation and oil, but yesterday's market action was fairly muted. Isn't it possible the market is already factoring in these risks?
It is possible, and that is why the debate is tricky. The tape can look calm even when risk is building, but valuations are still sensitive to rates. If the bond market continues to suggest no cuts, that could cap upside, especially in rate-sensitive areas like tech and consumer discretionary.
I hear you, but I am not sure I buy the idea that private credit risk is a near-term market mover. Isn't that more of a longer-term structural issue?
I'd agree it is more medium-term than today's trade, but it matters for sentiment. If traders sense tighter credit, they tend to avoid the weaker balance sheets. That affects small caps and highly leveraged companies. Today might not hinge on that, but it is part of the mood.
Let's cross-examine what would change your mind on the bull case. If you came into this morning leaning calm, what would flip you?
I'd change my mind if we saw evidence that inflation is not just an import price blip, but a broader trend across services. If that changes, so does the thesis. The market could price in higher rates for longer, and that can be a mood killer.
And the bear case, how much of it might be already priced in?
Some of it is we've had enough headlines about inflation and geopolitical risk that investors aren't asleep at the wheel. But the bear case isn't fully priced if energy spikes sharply or if the bond market reprices rate expectations in a more aggressive way. I could be wrong if companies show strong margin stability in the next round of reports, suggesting pricing power is sturdier than the bears think.
Where do you actually lean for today's session? Don't give advice, just give your stance.
I lean mildly cautious. With a steady hand, the cash flow stories are solid, but the near-term rate narrative feels less friendly. I expect more sector split than index drama. That means tech might feel heavier, while defensives could catch a bid. But I am watching the same mark as everyone else, is energy, rates, and whether the market treats today's open as a continuation or a reversal.
So you are leaning cautious, but not panicked.
Exactly. Think of it like checking the sky for rain. You still go out, you just bring a jacket.
You've mentioned balance sheets a few times. How does that translate into what investors should watch today? Again, not a recommendation, but where is the signal?
The signal is in companies with consistent cash flow and manageable debt loads. If those names hold up while high growth, high valuation names sag, that tells you the market is prioritizing stability. If we see a broad-based rally that includes speculative names, it suggests the market is still willing to look past inflation worries. Today's action might not settle the debate, but it will hint at which side is winning.
Let's make this concrete for listeners. Which sectors should they watch at the open?
Energy will be center stage because of the oil link. Financials matter because rates and credit expectations can shift their outlook. Tech is the pressure point since it is sensitive to rate narratives. And defensives like healthcare and staples are the shelters if anxiety rises.
And what about small caps?
Small caps are like the early crop in a cold spring. They can thrive if conditions are right, but they're more vulnerable if credit tightens or costs climb. If small caps lag while large caps hold, it is a sign that the market wants sturdier balance sheets.
Let's tackle the political headline in the mix. There is news about a possible US-China meeting in May. How much should we care today?
I'd file that under headline risk and policy overhang. It can shift sentiment for a day, especially if it changes trade expectations, but I wouldn't overweight it for today's price action. The market is focused on inflation and energy. Political noise can spice the stew, but it is not the base.
I like that. Now you are a value guy in a morning like this. Do you actually do anything different?
Not dramatically. I look at whether the long-term story is intact. If the business has a moat, generates free cash flow, and keeps debt manageable, then short-term noise doesn't change its intrinsic value much. It is like a barn built on solid ground. The wind can howl, but the foundation holds.
That is metaphor number 2. I am counting.
Fair enough. I'll keep it in check.
I want to circle back to the rate cut story. The headlines say rate cuts are on ice. If we assume that is true, does it mean we should expect a weaker open?
It could tilt the early tone slightly lower, but I wouldn't assume a straight line. Markets can absorb a no cut soon message if earnings are strong and margins are stable. The bigger issue is whether investors believe rates stay high into next year. That is what can change how they value growth companies today.
If I am hearing you right, today could be about how investors price the future, not just how they react to the present.
That is a good way to frame it. The short end of the curve is shouting, but the stock market cares about the long arc of profits. If those profits remain durable, today could just be a choppy session with a rotation under the surface.
Rotation is another phrase you always come back to. Do you think money is moving from one part of the market to another today?
Potentially, if rates feel higher for longer, investors may lean toward cash-generative businesses and away from speculative growth. That tends to show up as relative strength in value and defensives. It doesn't mean a collapse, but it does change the tone.
Let's challenge the bull case again. You said strong companies can pass on costs, but what if consumers finally say no to higher prices?
That is the risk to the bull case. If demand softens and companies can't pass through higher costs, margins take a hit. And if that happens while rates are still elevated, valuations can compress quickly. I am not saying that is imminent, but it is the reason I am only mildly constructive, not outright optimistic.
On the flip side, what is a sign the bear case is too pessimistic?
If we see stable demand and the market starts to reward companies with real pricing power, then the bear case loses steam. You'd likely see stronger performance in consumer staples and healthcare, along with steady industrials without a big sell-off in tech. That mix would tell you the market is absorbing the inflation story without panic.
You've been careful with your language, but I want to press you on one point. Are you saying today's inflation headlines aren't that important?
I am saying they matter, but they are one input. The market doesn't move on one data point alone. If today's import price story signals a broader trend, then it matters more. If it is a one-off driven by a specific category, it could fade quickly. I am watching for confirmation, not just the headline.
That is helpful for listeners who feel overwhelmed. Now, if you had to distill the debate in one sentence, what would it be?
The debate is whether the market believes inflation is a passing cloud or a persistent climate.
That is crisp. Let's talk about how pre-market sentiment might translate into action. Futures are modestly lower in this kind of setup, and oil is in focus. What do you expect in the first hour?
I'd expect a cautious open with a lot of cross currents. You may see initial selling in rate-sensitive names and some firmness in defensives, but the tone can shift quickly if energy prices stabilize or if rates ease a bit. Again, the open doesn't decide the day, but it sets the mood.
Give us a practical watch list without telling anyone what to do.
Watch energy majors, because they often signal how the market is interpreting geopolitics. Keep an eye on large cap tech as a proxy for rate sensitivity, and check in on financials for a read on credit sentiment. If all three are moving in different directions, it is a sign the market is wrestling with the same debate we're having.
You also mentioned defensives. What would strength there mean?
It could mean investors want stability and dividends, which tends to happen when they're uneasy about rates or growth. If defensives lead and cyclicals lag, it hints at caution. If everything moves together higher, it suggests the market is willing to look through the noise.
We've talked a lot about risks. You are required to acknowledge them a couple times, but I want to make sure we don't overdo it. What is the third and final way you'd frame the risk?
Here is the one that matters to me. The thesis gets challenged if energy costs feed into core inflation in a lasting way. That would make rate cuts less likely and squeeze companies that depend on cheap financing.
That is clear, and you are still grounded in the balance sheet.
Always cash flow and debt levels don't lie. In a day like today, that is where the calm lives.
We're in the resolution phase now. You've heard your own bull and bear cases. What is your final stance for the morning, and what should listeners watch to know which side is winning?
My stance is cautious but not defensive. I'd expect a market that is more about sector selection than a broad risk on or risk off move. The key tell is how the market treats rate-sensitive stocks versus cash-rich defensives. If tech stabilizers and financials don't roll over, the bull case is winning. If defensives outperform and growth fades, the bear case has the upper hand.
That is a good framework. And for people looking at the day ahead, the message isn't run for the hills, it is watch the signals.
Exactly. It is like watching the field for early frost. You don't rip out the crops, you just pay closer attention.
That is metaphor number 3. You are still within the limit.
I'll stop there.
Before we wrap, quick lightning round. One word for the tone of today's session. One word for the biggest driver. And one word for the most misunderstood risk. Concise as always, let me summarize in my own words. We're walking into a day where inflation headlines and oil risks could tug the market in opposite directions. Victor's view is that cash flow strength and balance sheets will matter more than the headlines, but rate sensitivity still carries weight. The debate isn't settled. It is playing out in sector leadership.
That is a fair summary, and I'd add quality still matters. A good business is a good business, even on a noisy morning.
I'll take that. Thanks for joining us, Victor.
Always a pleasure, Mandy.
And thanks to all of you for starting your day with Capital Sound. Keep an eye on energy, rates, and how the market treats cash-generative companies today. We'll be back tomorrow to unpack how it all unfolded. For now, have a steady trading day and goodbye.